Brilliant. So in terms of the agenda this morning, what I'll run through is firstly a little bit about Broadstone, just very briefly, just so for those that haven't come across us. Then what we'll look at is a few slides around planning for your retirement, and appreciate that some people will have had a chance to think quite a bit in detail about income requirements that they might need, what they're going to get when they want to retire, but appreciate a lot of people won't have had a chance to think about that. So there's some interesting survey results on there in terms of what people might need in retirement. So just gives you a bit of food for thought. We'll look at what the state pension will give you as well. So if you want to take that into account, we'll talk about the current pension plan that you're in at the minute. And then finally, what we'll do is look at how you actually get your money out of the plan, because obviously that's very important, and a few kind of points around transfers and beneficiaries, and then we'll look at any questions. One thing I didn't mention is kind of timing, probably take about 40 minutes to run through the presentation. So very brief background about Broadstone. What we do, we specialise in employee benefits. So that's our main bag. And what I mean by employee benefits is our clients are corporates, so like employers that want to provide benefits to employees. So what we're talking about here is the pension scheme. So we're appointed to the Royal Astronomical Society to provide them with advice on the current legal and general pension scheme that everybody is in. The other areas that we do play in are things like group life, private medical insurance, income protection, online benefits, cash plans, dental plans. That's the range of employee benefits that we advise companies on. Obviously today we're talking about the company workplace pension scheme. We are about 400 strong, Broadstone, so we have an office in London, not too far away from yourselves, and we go all the way down as far south as Bristol and up to Glasgow and Falkirk, which is great when we're doing face-to-face. Having 9 offices throughout the UK at the minute doesn't really mean anything, because all the meetings that we're doing and presentations, etc., are all through this kind of webinars. In terms of numbers, then that's quite important in terms of the size of us, because when we do need to speak to any of the providers, then they will actually sit up and listen. It's not as if we're kind of a 4-man company, and if a 4-man company goes knocking on Legal and General's door, they're unlikely to sit up and listen. But with 400 staff, we do have quite a lot of clients and quite a lot of business placed with the main providers. So the good news is they sit up and listen. This is myself here, Ian Roylands. I think the senior bit just means I've been doing this a long time and nothing else. So very brief background about Broadstone. As I mentioned, we'll start looking at planning for retirement. Now, this is a really interesting survey that Which did, and what they did was they surveyed retired and semi-retired couples, and they said, well, okay, as a household, how much income do you need or do you spend in retirement? And it was 6,000 of them that they surveyed, and the results came back, and it was split into 3 areas. And these couples were saying, well, okay, for an essential retirement to cover all the bills, what we'd really look to require is about £20,000 per year. Now, if we were looking at a comfortable lifestyle, they said, look, you're probably going to need about £27,000 a year. And then luxurious, you're then getting somewhere towards £40,000 per year. So starts to give you a little bit of food for thought if you haven't thought, okay, how much income, am I really going to need in retirement? So for these couples, somewhere between 20 to 40k per year. Now we can see on the right hand side here where all that money or income is being spent. Now we're looking at taking the middle one, so the comfortable lifestyle of 27,000. You can see their biggest spend was on holidays. So one of the biggest differences between these 3 bands of income was really what people were doing in their leisure time, so the holidays. So difference might have been, okay, how long they were going on holiday for. So for example, at the minute, probably not the best scenario is it at the minute, because nobody's going on holiday, but normally you might go away for 1 week, 2 weeks at most. These retirees, when they're looking at comfortable and luxurious, we're probably looking at going away for 3-4 weeks at a time. Also, how often they were going away as well. Whereas, when we're looking at how much annual leave we have, maybe once a year, twice a year maximum. These retirees may have been looking at 3-4 times a year. And also then finally kind of the destination as well. you know, whether it was a staycation looking at the UK, or the luxurious was then moving into kind of long haul holidays. So you can see there where the spend was, and it was mainly on the kind of pastimes and the leisure activities. So just a good kind of starting point, you know, if you haven't had a chance to think, you know, how much am I really going to need? This is from the horse's mouth saying, you know, what these couples required. So then once you've got an idea about what income you require, you then need to start looking, okay, where's it all going to come from? How am I going to get a pot of money to allow me to finish work? So the state pension will go some way to provide an income in retirement. Now, this question normally works well when we're face to face, but if you want to have a virtual show of hands, if you think what the state pension might be for a single person per week. So we're looking at some either £113, £125 or £175 a week. So the single state pension is about £760 per month, so £175 per week if you qualify for a full state pension. So it's round about 9k a year. So it's not an insignificant amount, 9,000. So it's something that you might want to take into account when you're planning your retirement. A couple of things to look at. If you read here, you can see how many years of national insurance you need to pay to qualify for it. So this is how you qualify for the state pension. The good thing is about the state pension, it's not means tested. It doesn't matter how much money you've got sitting in your bank account, it doesn't matter how much money you've saved into your pension, it doesn't matter what your house is worth. As long as you paid 35 years of national insurance, everybody will qualify for the full single state pension. If there's two of you in the household and you've both done 35 years, there's round about £18,000 that will be coming in at state retirement age. So something to bear in mind and factor in when you're looking at retirement income and also retirement age, because one of the key things here is actually when you can start drawing money from the scheme. So at the end of last year, the state retirement age changed fully from 65 to 66. So 65 doesn't mean anything now in terms of a state retirement age. It's currently 66. In 2028, that is due to change to 67. So if you were thinking, well, actually, I want to retire at 60 or 62 as an example, you know, if you thought, actually, my mortgage is going to be paid off at 62, that's when I want to retire, you're going to need to fund your retirement income completely by yourself, because the state retirement pension isn't going to kick in until 66, 67. And for the younger ones that are on the webinar this morning, probably not even until 68. So it just gives you an idea in terms of what you may get from the state pension. The other thing to bear in mind is, I've said 35 years to get a full state pension. If you don't manage to qualify for that number of years, they'll just prorata it. So as long as you've done at least 10 years worth of national insurance contributions being paid, you will get some form of state pension. Now, if you're getting closer to state retirement age and you want an idea of what you're likely to get back and what you're on track for from the state, then if you type it into the search engine and go onto gov.uk website, you can get a forecast from the in terms of what your state pension is likely to be. So then you can start planning a little bit better. Now, carrying on the slides, we were saying, well, these couples were saying, look, we need £27,000 a year for a comfortable lifestyle. If they were going to take into account the state pension, so that's going to go some way to provide the income, what would they need to save to make up that shortfall? So we've got two scenarios here. We've got couples that have no pension savings, and we've got couples that have got around about 100k in their pension pot. And you can see the different age bands here. So if I just pick out a couple of areas from this slide, if the couples were around about 50 and they had no pension savings, they would need to save about £800 a month to make up that shortfall, which would give them a pot of just over 200 grand, which would give them the difference between the 27k and the state pension. Now, if they had 100 grand already saved in their pot, because you'd expect 50-year-olds to have at least some form of pension savings, then that requirement would fall to £350. Now, you can see the difference in terms of how you can make the biggest impact in your retirement is when you're the furthest away. So if you're only aged 20 and you're looking at making up that shortfall, then if you had no pension savings, there's a couple you'd need to put £270 away, as opposed to couples there that were 50 that would need £800. So it just starts to give you a guide in terms of how much you would need to save to make up that shortfall. Now, this is taking into account that you're going to retire at state retirement. If you wanted to retire early, like I said, you'd need to start funding all that income by yourself, so these figures would actually go up. Now, I'll come to it in the presentation, but there are some good projection tools around there. So if you want a guide in terms of what you're on track for, then Legal & General have a pension projection tool, and there's many out there online that are free to use if you want a guide in terms of where you're heading. So hopefully a little bit of food for thought in terms of income requirements. Now, in terms of making up that shortfall, if it's retirement planning, pensions are still far and away the best way of doing it, because any contributions you make, you get tax relief on, which I'll come to. When the money goes into the pot, your pension plan, it grows tax efficiently. And then what we'll look at towards the end of the presentation is how you take your money out. And you can currently take up to 25% tax-free. So there's a lot of tax incentives for making contributions to pension schemes. So if we look at your company pension scheme that everybody's probably in as we speak. So an overview, and apologies if you're aware of how this works anyway. It's a group personal pension plan that you have. And what I mean by that is everybody has a series of individual pension pots. So you have a pension pot with your name on it, completely separate from all your other colleagues. The reason it's called a group scheme is that your employer pays into the plan, linked together by one sponsor and employer, and then Legal & General will allocate the monies. So it's completely separate from your employer and completely separate from everybody else. With the group personal pension, you have a lot of flexibility. So if you've been in a pension scheme as long as I have, in terms of transparency, you probably didn't get a lot of transparency 20, 30 years ago. You'd see it on your payslip, and then you'd get a paper statement come through the post that nobody could understand. Nowadays, you can view your pension pot online, so similar to online banking. If you want an up-to-date fund value, you can register online, and I'll point you in that direction. You also have a lot of control, and what I mean by control, you have control about where the money gets invested, if you want that choice. Also in terms of flexibility and control about retirement ages. So we spoke about the state retirement age being 66, 67. The age that you can take money from the personal pension plans is as early as 55, and you're in control of that. So the pension provider isn't telling you when you have to take the money, neither is your employer. It's down to you. The minimum age is 55. Now that is due to change. The consultation has just ended, and they're looking to bring that in probably this year in terms of taking it into legislation. So the minimum age you'll be looking at will be 57, and that will be from 2028. So I want to say that everybody's quickly doing a calculation in terms of when they get to 55 or 57. The reason they're looking at introducing or increasing the minimum age to 57 is that is when the state retirement age goes to 67. So they want to keep that 10-year gap between when you can draw your personal schemes and the state retirement age. A couple of other things. You can see the annual management charge on here. So again, quite transparent. It's the only charge that Legal & General take to manage the investments, 0.5% of the value of the fund. So the scheme is also doubles up as a auto enrolment compliance scheme, which allows your employer to meet their regulatory duties from their auto enrolment requirements. Now, auto enrolment schemes can have a charge cap or are capped anywhere up to 0.75%. So you can see there that you've got a management charge which was well below the auto enrolment charge cap, which is great because the lower the charges, obviously the less Legal & General take to manage your investments. So that's an overview of the pension provider in your scheme. If we start looking at contributions, so you will have been, if anybody's joined recently, you will have been auto-enrolled into the scheme because that's what your employer has to do. They have to put you automatically into the scheme. Now you can see the level of contributions that your employer will pay, and so they will actually go up to 10%. Now, to put that in perspective, the minimum auto-enrolment requirements for an employer is they have to put at least 3% in. So you can see that all these contribution bases are higher than the minimum requirement. So what I would do is I would recommend just checking what contribution you're paying, and if you can afford to, then get as much money from the employer as they're willing to put in, because you can see there they're willing to go up to 10%, so it's a fantastic level of contribution. And your contribution is net of basic rate tax, which I'll come to. So you can see there that the total contributions that will go in are quite significant. So if you can afford to put a little bit more in, then just check what level you're on and see whether you can get some increased contribution from the employer, because that they're willing to do that. So it's a very good contribution structure. If we look at how the contributions are made now, so you'll see your contribution coming off your payslip, and it's made net of basic rate tax, regardless of whether you're a higher rate or basic rate taxpayer. The advantage of contributing to a pension scheme over and above any other forms of saving is that you will get tax relief on your contributions. So what happens is you pay tax on your contributions, they go over to the pension provider, and then pension provider, Legal & General, will reclaim back the basic rate tax you paid on that. So for every £100 that goes in for basic rate taxpayer, the net cost is actually only 80. So you're getting money coming in from 3 different sources. You put money in, the taxman puts money in, and your employer puts money in. In terms of any higher rate taxpayers that are listening, the principle works pretty much the same. Your contribution is still only deducted net of basic rate. Legal & General reclaim back the basic rate that's been deducted, and then you will need to do a self-assessment or a tax return, because you are entitled to relief at your highest rate. So either way, you'll get basic rate going into the scheme, and then just for any higher rate taxpayers, you just need to go to the taxman to reclaim that extra rate if you're not doing that already. So hopefully that makes sense. And you can see here, as I mentioned, about pension planning, and if you were looking at boosting your retirement pot, why it's kind of the best way of doing it. If we look at the first example here, somebody that's on a £30,000 salary, on the minimum levels of contributions, you can see that's £200 that's gone in, but the individual's only had to put 64 in. So for most other forms of savings, if you put £64 into that, then it's only £64 that's gone in. The reason I'm saying if you're boosting your retirement income, it's the best way of doing it, because there's caveats in terms of how long the money needs to be in there for, because you can't draw it till 55. So if you wanted something that's short term, you're saving to get married, you're saving for a house, you want to replace the car, that's when other forms of savings come into play. So there isn't a right or wrong way to save. Some savings plans aren't right or wrong, it's just your time horizon. So if it's retirement planning, you can see that it's the best way of boosting the pot quite considerably. Continuing the theme of contributions, so the revenue is always looking at how much tax relief people are getting from pension schemes, because it does run into the billions of pounds. So they're always looking at kind of tweaking around the edges and tailoring that. And there was a few things, actually probably there's only very few things that came out from the budget last week, which I'll run through. What currently in place is an annual allowance in terms of how much you can contribute. Now look, for 99% of people, they don't need to worry about the annual allowance limit, but it's just to make you aware. Anybody can contribute up to 100% of your salary, or £40,000 per year, whichever is lower, and still receive tax relief on your contributions. So it's still a huge amount, because this annual allowance, everybody has that, unless you get to very high salaries. So if you're in the privileged position that your total remuneration exceeded £240,000 per year, this allowance would start to come down, and it would start to take quite significantly. Nice problem to have if you have it, but it's just to be aware as well. And I guess the other thing is, William mentioning this, if somebody wanted to put lump sums into the pension, which they can, then the limit you'd be capped at is £40,000 to get your tax relief, unless you started utilising unused reliefs. If this is an area that you think you're going to be impacted on, quite happy to have a separate conversation. The other thing to bear in mind is lifetime allowance. Now, this is how much you can save over the lifetime of your pensions, so get all your pension pots, add them all together. If it's looking like exceeding just over £1 million, then again, a nice problem to have. You'd end up paying tax at quite a high rate on the excess above that. To calculate that, appreciate that some people may have been in a final salary scheme and you will have been told you'll get a pension per year as opposed to this is your pot of money. So if that's the case, for example, if somebody was told they're going to get £20,000 a year from a final salary scheme, you need to multiply that by a factor of 20. So in that case, that will be £400,000 that will go towards your lifetime allowance. The only thing that's changed in the budget is that this was due, this allowance, to increase every year in line with CPI. They've frozen that for the term of the government. So for the next 4 years, this 1.073 will be capped. So it will catch a few more people that are close to that. Like I say, nice problems to have, but if you have them, then quite have to have separate conversations. So this is really interesting when we start looking at how much you, or not how much you can put in, but how the contributions go into the plan and the benefit of pound cost averaging. Now, this is really kind of pertinent when the stock market fluctuates. And as everybody would have been aware last year, it really did that. It kind of plummeted when kind of COVID struck quite heavily, probably this time last year. So the benefit of pound cost averaging, this is somebody that's put in £100 a month contribution. So imagine your contribution, it's the same every month, goes into your plan. Now, what happens is you buy units within the default investment fund, which I'll explain in a second. So say, for example, the cost of buying a unit within that fund is £1. So simple maths, we can all do that. It's £100 value and you've bought 100 units. So say we get to, it was April last year and the stock market had fallen. So the fund, your fund value had fallen. So the cost of buying units within the fund was now only 80p. So this individual is still in putting 100 in. You can see they've actually bought more units than the previous month because it costs less. So you've now got 225 units. Say we moved on a couple of months and we're now June, July last year when the stock market really did take a dip. And so the cost of buying units within the fund was now only 50p compared to a few months earlier when it was £1. So that same amount is still going in, but because the cost has come down, they bought twice as many units as the first one. It's now £425. We now get to the back end of last year, start of this year, when the stock market has returned. So the value had returned to similar to what it was a few months ago. So you can see that £100 is now back to buying 100 units. You can see there for the £400 that's gone in, even though the fund has not grown, it's actually dropped and then come back to the same levels. The value of the individual's pot is now £525. The reason being that in month 2, you as an individual are buying units at a low rate. So that's the advantage of pound cost averaging. So take that peace of mind that when your overall fund value had actually dropped, which everybody's across the UK did, you were actually buying units within the fund and buying more during those low months. Now, in terms of where that's invested, most people will be in the default fund unless they decided to select their own funds outside of the default fund. Now, a default fund is a balanced risk, so it's a medium spread of investments. The majority of it is in the UK and overseas equities. You have government bonds and corporate bonds. You have a little bit of property investments and a little bit of cash. So it's a wide spread of investment. It's classed as medium risk. With Legal & General, the asset allocation or the equity content, what I mean by equity is shares, is probably round about 40 to 45%. So that's the biggest holding. The reason being that over the long term, shares will give the best return. And what you're trying to do is get the best return over the long term. Over the short term, then there will be blips as there was last year, as there was like the 2008. However, it will always come back, and it always has done. What will happen as you get closer to retirement, which I'll touch on in a second, so that's the default fund, which the vast majority of you will be invested in. If you want to select your own funds, there's the best of both worlds. You can either stay in the default fund or you can select funds from all these various fund managers. Just to give you peace of mind, we tend to find 1% of membership at most will invest outside of that. So if you're in the default fund, then that is absolutely fine. What happens with Legal & General, around 3 years from your retirement, what they will do is write to you and say, look, how do you want to draw money from the plan? Which route are you thinking of taking? And I'll explain these in a little bit more detail towards the end of the presentation. Are you thinking of buying an annuity? Are you thinking of just leaving the money invested in the plan and drawing down from it like a savings plan? Or are you looking at perhaps wanting to take it all out as cash? So either way, if you don't make a selection, then 3 years from retirement, the risk will start to reduce anyway. But these will just tailor it to these three outcomes. Appreciate that a lot of people might not even be aware of the outcomes that you can look at in retirement. So if you don't, it will still start reducing that level of risk. So the advantage of that is that you can see here, reducing the risk means that you're not really going to be heavily invested in the stock market if you've only got 1 or 2 years to go. So if you want more information on the scheme, Legal & General, like a lot of the other providers, have invested heavily in their online capability, because nowadays that's where pretty much everybody goes to get information. It's online. So you can see that the link there to register, and what you can do, you can get, you can see the value of your investments. So you can see where it's invested, which fund it is, what the actual fund value is. There's also a projection tool on there. So if you want to have a guide in terms of actually where am I heading, what might I be getting at retirement, there's some good projection tools in there. You can put your contributions, you can put fund values, whether it's a fund value from this current scheme or whether it's a fund value from somewhere else. Then you can build that into the calculator and it will give you an idea of what you're likely to get back. Now, in terms of drawing income from the plan, so we've spoken about the tax advantage of money going in, and then also where it goes. If we now have a look at how you get the money out, so there's 4 options that you can look at in terms of getting the money out. Prior to George Osborne's introduction of his pension freedoms and choice, there was only the one option, and that was buying an annuity. And what an annuity was, and apologies if you're aware anyway, is what we'll talk about is, let's always use for easier figures, 100 grand pot. So you can see here that regardless of how much tax-free cash or not you take, then you still have these 4 options. So you can take 25% of the pot tax-free. So on that 100 grand pot, easy to work out, 25 grand you can take, and that's your maximum tax-free cash. You then have to decide what you do with the remaining 75,000 or 75%. So you can give that to the insurance company, and in return, what they will do is say, well, okay, thank you very much for the 75,000, that's ours now. But in return, what we'll do is guarantee to give you X amount per year for the rest of your life. And we as the insurance company, not us, because we're the consultants, but Legal & General in this example, will pay out X amount for as long as you live, regardless of how long you live. So they take that risk. Not too many people do that anymore for a couple of reasons. One is the rates the insurance companies are providing aren't great. People don't like the returns. And secondly, passing the money on to beneficiaries is not as flexible as the next option. So the feedback we're getting from the insurance company is that 2/3 of retirees go into flexi access drawdown. Now, the simplest way to understand that is just imagine your pension is a savings pot. It's a little pot of money or a big pot of money, and when you get to retirement, you tell the insurance company how much you want per year, and then they will provide that to you. There are some advantages and disadvantages to all of these things. So the advantage of this is you're in control. So for example, if you want more money in the early years because you're going to be more active and the state pension might not have kicked in, you can say I want, £20,000 per year. If the state pension then starts to kick in, you may then decide, actually, I want to reduce this income down. So that's one good thing. Passing it on to beneficiaries is a lot easier because the pot of money is still there. I'll explain how you can pass that on when we get to a few slides later. The downside to this is that you may draw money too quickly from the pot, that in 5 years you might have used it all up. So it's getting that balance right. But this is, just to give you that kind of wider picture, this is what most people are doing in the time. One of your other options is taking it all as cash. So after you've taken your tax-free lump sum, then what we're seeing is that if you've got a smaller pot of money, and for example, what we mean by a smaller pot is say £10,000, then they're tending to find those individuals take the remaining 7.5 grand in that example as cash, because they don't want to take it a small amount every year. It probably wouldn't be right for somebody using this £100,000 pot example, because anything over and above the 25% tax-free is assessed for income tax. So if you took the other £75,000 all in one go, it's like having a £75,000 salary and you're going to pay tax on the majority of it. So it might make more sense to take it out over a longer period, so you pay either no tax or little tax, because everybody still has your tax-free allowance even in retirement. So currently you have a £12,500 allowance in terms of that's how much you can earn before you pay tax. And that's the same when you're retired as well. And then finally, the fourth option is straightforward, is a mixture of all those three. So you can kind of mix it up if you want to. So that gives you an idea of how you can get the money out. Now, going back to how Legal and General can help, one of their calculators you can take advantage of is, if you're getting close to retirement, you can look at the 3 different options. So, don't worry too much about the figures there. I'm just explaining the concept. If you were looking at taking it as an annuity, so an income per year, it will tell you how much you might be entitled to. If you wanted to take X amount per year as a drawdown, so I don't know whether you can see that, but it's saying, okay, if you were to draw £15,000 from your pension pot, and that's saying 121,000, then by the age of 71, it will have run out. So I think it's quite a good sophisticated calculator to look at. And it's saying, well, okay, if you wanted to take that all as cash, then that's your cash lump sum. However, you've got a 25 grand tax bill. That's why when people are looking at pots of this size, they don't really look at the cash element or taking it all as cash, because the tax implications are pretty significant. So that's really useful, I think, if you can look at the 3 different options, but the middle one is what most people go for. So look at a few other things before we kind of take any questions. What happens if you leave your employer? So appreciate that you don't have one job for life. So you can see here the options that you've got. And pretty much again, the important thing is you're in control. It's your choice. You decide what you do. If you're going back to the start of the presentation, this is your individual pension. So if you leave your employment, the link between your employer is severed and you have a personal pension with Legal and General. So you can decide what you want to do with it, which is great. Death benefits. People want to know, how can I pass that on? Does it die with me? Can the beneficiaries get it? Absolutely. So this is one of the reasons why a lot of people go into the drawdown, because the beneficiary is a lot more flexible. So the key thing to remember is not how you've drawn the benefits or whether you've drawn them, it's the age. So if you pass away under 75, then there will be tax that will need to be paid on the fund, and that's calculated on your beneficiary's marginal rate. So if it goes to beneficiaries and their basic rate taxpayers, then income tax will need to be paid. Sorry, under 75, wrong way around. Under 75, there's no tax. It's only over 75 if you pass away, then there's potentially income tax. There isn't any inheritance tax. So on this example we've used, if you've got a 100 grand pot and you haven't drawn any money from it, that doesn't fall into your estate. So it's not free of inheritance tax. It's just potentially income tax that might be payable. To make sure it goes to the right person, if you've joined the scheme, Legal and General will have asked you to complete an expression of wish form or nomination of beneficiary, whichever way you look at it. That will allow Legal and General to have a good picture in terms of who you'd like the money to go to. So 2 things: if you haven't done it, contact Legal and General and complete it. If you've done it a while ago and you think it's out of date, again, contact them and update it. Now, the providers, whether it's GDPR or whether it's just systems, they won't tell you who you've got down as beneficiaries. So if you're not sure, it might just be wise to update it, because any new expression of wish will just supersede and override anything that Legal & General already have logged. So just gives you the picture there in terms of beneficiaries. Just kind of finally, or nearly finally, in terms of transfer, so this is kind of probably the most questions we get. If you want to transfer money in, can you do that? So yes, Legal & General, like other providers, the more money under management they've got, the more money they can generate for the policyholders and themselves. So they want money under management. So the providers have made it as streamlined as possible to transfer money in. So if you want to transfer a similar type of pot in, contact Legal & General and they will help you transfer the money in. So there's I would say, if it's a similar type of plan and you're not sure whether to transfer it or whether it's the best thing to do, there's 3 questions that I would say get answers to, and hopefully this will allow you to make a decision. The first thing is compare the management charges. So you now know that the Legal & General, if you didn't already, is on 0.5%. Find out what your other pension scheme is on. Is it lower or is it higher? So that will help you determine whether you want to move it in. The other thing is look to see whether there's any penalties, and that's quite easy to do. Get a statement out from your previous plan and it will say fund value, and then underneath directly it should say transfer value. If the 2 figures are exactly the same, there is no penalty to transfer it. The third thing, we normally say thirdly and most importantly, but on this case it's not, it's just thirdly. It's probably less important, but you still need to check it. Are you giving up any guarantees by moving from your previous scheme? With the advent of stakeholder pensions that came in 2001, there are less guarantees around now on pension schemes. So I would say 99 times out of 100 there isn't. I'd probably say 999 times out of 1,000 there's no guarantees on pension plans anymore. But it's worth checking. So those are the 3 things. Check the management charge, check for any penalties. Legal & General won't charge you anything for moving it in or take any of the money, and just check if there's any guarantee. So hopefully that will allow you to make an informed decision. If you want somebody to make that decision for you, that's when you will need individual financial advice. So if you do want advice, we can point you in the direction of our advisors who are quite happy to have that separate conversation. If you've got your own advisor, then have that conversation with them if you prefer. So hopefully that answers questions about transfers. So that's transfers going in. Transfers coming out. So if you want to move out of Legal & General, and we'll just use the same example of that 100 grand pot, Legal & General won't impose any penalties, so you can move that 100 grand pot to another provider. So that works for similar types of investments. If it's a final salary or a defined benefit scheme, it's a completely different kettle of fish, and you would need to take advice. So to really just summarise before we kind of open it up for questions, we're about 1/4 so hopefully we're on time, is that you get a great level of contribution from your company, your employer. So look at what you're getting and whether there's an advantage to take a higher level. There's a lot of tax reliefs on retirement planning and pension planning. So if you want to boost your retirement pot, best way of doing it because of the tax efficient growth and the relief on the contributions. And then there's even tax reliefs when you start to draw money from the scheme as well. So a couple of pointers there for information. You can register online there with Legal & General. There's a helpline there with them. As Mark kindly pointed out at the start of the presentation, if you want to alter your contributions, then just contact Mark and he'll be able to make that amendment. I hope you found that useful and picked up, at least some value from some of the slides.